If you thought 2021 couldn't get any weirder, think again. We have moved from there won't be inflation, to there is no inflation, to inflation is transitory, to now inflation is good. John Schwartz, who writes for The Intercept, a media organisation that aims to hold the powerful accountable through fearless adversarial journalism, recently penned an article titled "Inflation is Good for You." His byline implores everyone not to panic over rising milk prices and states that inflation is bad for the 1%, but helps out almost everyone else. Unsurprisingly, his article raised a few eyebrows, given it goes against the normal understanding that high inflation is bad for the general populace. In this video, we'll examine each of the arguments raised in the article, and whether he has a point, or whether he's completely off the mark. This video is brought to you by I Dream of Money, the channel bringing you videos about business, economics, and money. Help us reach 1,000 subscribers by clicking on the like and subscribe buttons so you never miss out on a video to help you become a better investor. The author starts his article as follows. The top story on the New York Times website this morning is about inflation, and it's scary. Inflation spiked in October, sinking Washington's hopes that price gains would slow down. The Washington Post led with a similar call for alarm. Prices climbed 6.2% in October compared to last year, the largest increase in 30 years, as inflation strains the economy. Whenever the corporate media moves en masse like this, it's a good idea to slow down and consider what's actually happening and why. Here the author is setting the scene for his suspicion that inflation is actually good for you. If the corporate media is saying inflation is scary, then we should definitely be thinking the opposite. This theme of a distrust of corporate media colours the rest of the article. He goes on, and what's happening is this. The inflation freakout is all about class conflict. In fact, it may be the fundamental class conflict, that between creditors and debtors, a fight that's been going on since the foundation of the United States. That's because inflation is often good for most of us, but it's terrible for the kinds of people who own corporate news outlets or, say, founded coal firms. And a panic about inflation usefully creates the conditions to weaken the power of working people. So the logic of this statement is that evil companies such as corporate news outlets and coal firms hate inflation. It therefore follows that the average working person should love inflation. Never mind that corporate news outlets and coal firms employ working people. If inflation is bad for them, then it must be good for you. The author then quotes some statistics. Today's stories were generated by the release of inflation numbers for October by the US Bureau of Labor Statistics. BLS found that prices for all goods rose 0.9% in the last month. In other words, on average, products that cost $10 in September now cost a terrifying $10.09. Also, overall prices are now 6.2% higher than they were a year ago. So something that cost $10 in October 2020 is now $10.62. You'll notice here that both the Times and Post were misleading about this. The Post headline, "Prices climbed 6.2% in October compared to last year," makes it sound like prices went up 6.2% in October, i.e. in 1 month. The Times similarly has a graph with a label saying prices went up 6.2% in October. That truly would be a problem. Fortunately, that didn't happen. The author is correct that the corporate media is being somewhat misleading, as the 6.2% figure is based on 12 months of data. However, when you look at the BLS's breakdown of the items index, in the month of October, energy prices went up by 4.8% in a single month. Fuel prices went up by a staggering 12.3% in a single month. So given the author admits that prices going up by 6.2% in the month of October would truly be a problem, then wouldn't the rise in energy prices be something to be concerned about? Further, the author is being disingenuous by using an example of something that costs $10 being only 62 cents more. In fact, the BLS reports that the average household spent $61,334 in 2020. So 6.2% multiplied by 61,334 turns into $3,803 on average a year, which is not insignificant. The author continues, so why has inflation seized the imagination of the corporate press? It's simple. First, inflation lessens the real value of debt. In 2020, American households had around $14.5 trillion in debt from their mortgages, credit cards, student loans, and other sources. Inflation of 6.2% means that the real value of that $14.5 trillion is now just $13.65 trillion in last year's dollars. In other words, the inflation over the past year has effectively transferred $850 billion in wealth from creditors to debtors. That's a lot of money. Most people are a mixture of creditors, e.g. you have a bank account, and debtors, you have a mortgage and student loans. But overall, this $850 billion has generated a big check written by the tippy top of the income scale to everyone else. And as you'd expect, the people at the tippy top don't like this. As alluded to at the start of the article, the author's argument boils down to a supposed fight between debtors and creditors, where borrowers are winning and lenders are losing. The author does admit that most people both save money and owe money. However, this is a half-truth. It would have been more relevant to say that certain people are net savers and certain people are net borrowers. For net savers such as retirees, inflation eats into their retirement savings. The author's simplistic calculation of the transfer of wealth from creditors to debtors of $850 billion also only looks at the debt side. According to the World Bank, Americans had gross savings of $4 trillion in 2020. So if we use his simplistic calculation, these net savers are losing about $250 billion. The author somehow also jumps to the conclusion that the tippy top of the income scale are somehow losing in all of this. It would seem that he is using this as shorthand for saying banks, which do the lending, are losing in all of this. But banks are ultimately funded by people, and if you follow the money, you will see that banks are funded primarily in the following three ways. First, deposits. Secondly, borrowing money in the capital market by issuing fixed income bonds or other debt instruments. And thirdly, equity investment. Deposits are provided by the general public. Therefore, ultimately, it is the people who save who are the creditors, not the banks. The burden therefore falls on everyone who has a deposit, and not the 1% who are likely to be holding most of their wealth in other assets rather than cash deposits in banks. In terms of who goes out and buys fixed income bonds and debt instruments from banks, it is typically vehicles with a low risk profile, such as pension funds, insurers, sovereign wealth funds, and retirees. Again, this pushes the cost of lending to everyone, not the super rich who likely have their own retirement assets to draw from. Similarly, low-risk bank stocks are generally held by similar investors. So long story short, inflation is basically screwing grandma and grandpa. The author goes on to his next reason why inflation is good. Second, inflation generally accompanies economic booms when the unemployment rate is low and workers have the market power to demand higher pay. That's what's happening now. As prices increased 6.2% over the past year, wages for regular people went up 5.8%. In other words, inflation barely touched their purchasing power. And with almost 300 labour strikes in the US so far this year, workers are leveraging their power to demand better compensation at historic rates. So while inflation can be a significant problem for workers if they don't get it back in higher paychecks, that seems unlikely today. The assertion that inflation generally accompanies economic booms is a statement of correlation. However, it's not always true. Inflation can be caused by a number of things, including supply shocks and printing money, and it would seem that those factors are the true cause of high inflation at the moment, with well-documented cases of logistical issues with imports and significant quantitative easing being undertaken by the Federal Reserve. As for why wages are going up, the author says this is because of lower unemployment. Whilst it's true that the US unemployment rate is going down, what this fails to also recognise is that the participation rate has also plunged. An employment rate is calculated based on the number of people employed divided by the number of people who participate in the job market, not the entire population. It would therefore seem that the employment rate is only being propped up because people are increasingly opting out of the workforce, therefore reducing the denominator in that calculation. This doesn't indicate a booming economy, but rather people losing hope in finding jobs. Therefore, whilst the purchasing power of the people who remain in the workforce is currently keeping up with inflation, many people who are no longer looking for jobs are increasingly being left behind. The article concludes as follows. However, there is one rock that can kill both these birds at the same time. The Federal Reserve can raise interest rates. This would slow the economy and increase the unemployment rate, lessening worker bargaining power. Less bargaining power would mean lower or non-existent raises, which would eventually translate into lower inflation. That's what all today's inflation panic is ultimately aimed at, creating an economy with higher unemployment, lower growth, and more frightened workers. Whether America's creditors can make this happen remains to be seen, but we shouldn't have any illusions about what they're trying to do, and we definitely shouldn't help them do it. As I described above, it is simply incorrect to equate creditors with the wealthy. Wealthy people don't get rich investing in bank deposits and bonds, they get rich investing in assets with significantly higher returns. I've outlined in a previous video that measuring inflation based on a goods and services index or CPI isn't the full story. We've seen empirically that asset inflation is running away and family homes are becoming increasingly unaffordable. Therefore, this article ignores the elephant in the room. Asset inflation is far outstripping CPI inflation. The wealthier you are, the more assets you hold. The current low inflation environment has only increased the gap between the wealthy and the poor. It is therefore likely the case that the 1% are in fact doing a lot of borrowing and fueling asset prices with cheap funds. So arguably, it is only by increasing the interest rate and the debt-fueled asset bubbles will come to an end and close the wealth gap. The wealthy would therefore be opposed rather than in favour of an interest rate hike. Overall, my view is that the arguments put forward by the author that inflation is good for people and therefore somehow bad for the 1% aren't very compelling and fundamentally don't understand what is driving inflation and how people invest their money. Let me know in the comments below whether you agree or disagree with my response to this article. If you like this video, please remember to like and subscribe to this channel. Thanks for watching, and until next time.